All right, well, right now we're seeing a positive start to March, not by much. We did see a positive end to February after some inflation data stateside came in as expected. It kept the belief alive that we'll eventually start to see interest rate cuts in the U.S., and obviously we're watching that story very closely here in Canada. But if some of those cuts don't materialize, our next guest says that could start to impact the profit picture going forward. Lauren Goodwin is both an economist and the chief market strategist at New York Life Investments. Lauren, it is great to see you. Thanks for joining us.
Oh, good morning, John. It's great to see you.
Why don't you connect the dots for us here? Because this is this constant narrative, people expecting that interest rates will start to come down, but we don't know. And what is ultimately at stake when it comes to the profit picture for big companies?
One element that's been so central to the positive market performance of the US and Canada over the past couple of years has been renewed economic activity, economic surprises to the upside. And though it's taken a long time for interest rates to impact the broader economy, we do still see that impact unfolding over time. And so the longer that inflation remains sticky, that interest rates remain higher, actually the more challenging any impending slowdown would become. Right now, in both the US and Canada, credit, businesses, households looks pretty good. Revenues look pretty good. The longer that we remain in a late cycle environment, the more time we have for stress to build in the system, and ultimately the more challenging we think an impending recession would be.
And one of the things at moments when we did have sell-offs in the equity market, call it over the last 12 months, oftentimes it was triggered by the bond market because, again, you're having this dialogue around what happens with interest rates. And for companies, if borrowing costs are higher, that's a complicating factor. But even just if higher interest rates impact a whole host of economic considerations, including the health of the consumer, I guess that's an earnings consideration as well. When you have to put all of this in the context of the markets, what have you been talking with your clients about? What are basically your recommendations for investors right now?
Well, the one hallmark of the economy over the past 3 years that's been remarkably consistent is uncertainty. Even the conviction that we see in the market today that central banks may hold off on interest rates cuts is only a couple of weeks old. Right. It's not been so long since we were seeing a major Fed and central bank pivot rally. And before that, it wasn't so long before we'd seen a real contraction in financial conditions. So in that type of ebb and flow, a couple of things that we think are particularly important. First, tactically, this is all about financial conditions. And because right now financial conditions are actually loosening in the US and Canada, that's a signal to us to stay invested. But how do you stay invested is really the question. And there we look at a combination of solid earnings, reliable growth with secular themes. I'll give just one example for the equity market. When you're concerned about revenues potentially slowing ahead, you might invest in strong revenue companies. That might look like the mega cap tech companies. But being concerned about valuation, maybe you broaden that exposure by looking at more related themes, the small and mid-cap growth companies that are likely to be the next beneficiaries of AI, for example, or the infrastructure that supports the AI trend. It's just one example, but that's the type of portfolio construction tactic we think is important to balance the risk and opportunity at hand in this market.
Okay, so keep an eye on structural allocation to commodities and real assets. You know, real estate's an interesting category in itself because it combines a lot of different stuff. But in very general terms, Lauren, you're the economist and the market strategist, so you can correct me. But when there is a dialogue around interest rates, we do tend to see some of these interest rate sensitive stocks move in the market. And I would say, generally speaking, we've seen some weakness in some of these areas. You see some opportunity longer term. Can you walk us through how that works?
Absolutely. I think you might have said it best, John, by saying there's a lot of stuff in real estate. And I think because of the secular changes that have happened post-pandemic, especially with respect to office space in the US, there's also been a lot of migration within the US to different areas of the country. This creates a lot of disruption and potentially some weakness, some concern, some risk. but there's also opportunities. Data centers, especially data centers inner city, where they're more required for the AI boom. This is one area of structured investment. Multifamily housing, especially in areas where it's in such high demand. These are areas that are gaining higher rents, more reliable cash flows, and have had some price action, negative price action as a result of rates moving higher, as you mentioned. So it's an area where I think investors need to tread particularly carefully, but one in which sentiment has in some cases created what we see as generational opportunities for buy and hold in real estate.